Matthew, you are somebody who has worked a lot on the Wall Street with the institutions on one side, traditional finance, and now on the other side, you are of course building these amazing protocols whereby people can enjoy these yields, which are far more better than traditional finance. How do you convince or onboard these large institutions?
I think it depends on what type of institutions. If we mean like
Mhm.
institutions like LPs, right, like the large LPs, like the flow desks of the world and the
Uh-huh.
yield curators like Edge Capital, so on and so forth, then I think it's primarily around your risk models. What are you doing to be more transparent, so on and so forth, right? They have, and
Mhm.
like these firms are tending to be quite safe because of all the hacks that have happened as of
Mhm.
recent, and all the loss of funds that have happened. So I think these firms are more worried about those type of things, but are still looking to deploy. Whereas, like what I would say, true institutions are, which is Fidelities, which is BlackRocks and stuff like this. I
Mhm.
don't think they're really touching DeFi in any meaningful way, and I don't think they're doing that for a very, very long while because fundamentally we don't have the regulatory setup for them to be able to touch DeFi. And if we did have the regulatory setup for them to touch DeFi, then either the world has changed a lot or it's centralized finance and it's not DeFi.
Hello everyone, welcome to yet another episode of Voice of Web3 powered by CoinGape News. I am Sunil Sharma, Chief Editor at CoinGape. I know most of you are actually looking at the recent events in Web in DeFi particularly, and definitely it's not a very good situation. The recent hacks definitely have created a huge impact on the trust that people have on these DeFi protocols. And DeFi is finally getting into mainstream. DeFi is being debated at large roundtables among the institutes as well. And today we have somebody who will help us to shed more light on DeFi particularly. He will help us understand what sort of future we can expect when it comes to decentralized finance and what sort of reaction or what sort of adoption we are already seeing, which may not be visible in the press or media. So guys, today we have with us Matthew Pinnock. Matthew is the Chief Operating Officer at Altura. Altura is a decentralized finance platform and it specializes in the non custodial yield strategies and multi chain liquidity. Matthew has an extensive background in traditional finance as well and institutional trading. He has a long tenure as an executive director at Goldman Sachs. He has bridged the gap between legacy financial infrastructure and the rapidly evolving world of Web3 as well. Particularly at Altura, you may have heard about him or you may have seen him speaking about operations and strategic growth. He is focusing on making DeFi more accessible, secure for both retail as well as institutional participations. He's particularly vocal on the frameworks like MiCA in Europe. So he will help us understand the ongoing regulatory environment as well. So guys, before without any ado, without any wait, let's welcome Matthew to the stage. Hi Matthew, how are you?
Hi, I'm fine, thank you. How are you?
I'm also doing great, Matthew. And this is the timing couldn't have been more perfect. I
Yeah.
mean, the DeFi is definitely in the buzz, not because of the very good reasons, I must say, but there is a lot to discuss, there is a lot to debate. And thanks again for being with us. And how are you? And where are you?
Yeah, thank you for the amazing intro. So I'm based in London right now, actually. So it's
Mhm,
kind of institutional crypto hub, if you will.
mhm.
And I'm doing great. Crypto's booming, Altura's booming, in a different way. Not like we're in a bull market, but more like a lot of utilities getting built, a lot of
Mhm.
RWAs getting tokenized. So yeah, I'm in a good place. I'm happy.
So, Matthew, I mean, one question we always ask our guests on the podcast, and which we are very curious to know about since being native to the crypto and Web3 space for last 8 years, is what brought you to the space and how did you hear about Web3? What made you to enter the space? Because I am sure you had a very successful career in traditional finance and Web2. So, what made you enter Web3? What was an inspiration?
Yeah, so I actually entered Web3 from the degen slash privacy perspective. So
Okay.
I did ethical hacking at university.
Mhm.
It was at university where I basically figured out that instead of breaking into platforms,
Mm-hmm.
I wanted to use cryptography to build something useful, right? At that point, I read the Ethereum white paper, and from then I fell in love with cryptocurrency,
Mm-hmm.
right, and the beautiful world that it is. So I ran a few of my own projects, and then I joined Fidelity for a few years, deployed their money market funds, tokenized their bonds, and then from there I joined Altura because, frankly, institutions move incredibly slow. Don't know if you
Mm-hmm.
ever
Right,
in
right.
TradFi, but
Mm-hmm.
yeah, painfully slow. And so, yeah, I wanted something faster paced that felt like it was affecting more on the ground.
Mm-hmm.
So I joined Altura as their COO and head of tokenization, and we've done so much since. We've
Mm-hmm.
bought gold trade directly onto the blockchain. We have incredible quants. We're at nearly 15 million TVL right now, and we still have around 20% APY. So, yeah,
So, Matthew, if somebody is hearing about Altura for the first time and they want to understand that how exactly they can benefit from the platform, then how should they understand the platform? I mean, what are the benefits that Altura gives to anybody today?
yeah. So Altura is a multi-strategy yield vault. What that basically means is that
Mm-hmm.
we diversify risk by running multiple different strategies on our own desk with users' capital, right? So it effectively, like vaults are a buzzword for funds, right? On-chain funds that basically don't require KYC, right?
Mm-hmm.
And so Altura, so the main strategies we deploy to are like market making, funding rate arbitrage, as well as RWA and commodities trading, where RWAs is everything from private credit to
Mm-hmm.
tokenized physical gold and the arbitrage of gold cross border. And so the primary benefit that you get by deploying with Altura is APY, but also risk diversification and yield
Mm-hmm.
diversification at source. So yeah.
So, when I'm discussing or debating DeFi with people on the Wall Street, one thing I'm seeing is there is a lack of trust. I can see that there is still a hesitation when it comes to discussing DeFi. Of course, they are more comfortable in discussing about Bitcoin or maybe the coins like Ethereum, Solana, treasuries, maybe some form of tokenization, even like stocks. But when we talk about DeFi, particularly the DeFi associated yield with it, there still seems to be a bit lack of trust. And this is what I wanted to ask from you, that do you see this is the right time for DeFi now, or do you still see 2 to 3 years of gap where the industry actually catches up with it, traditional finance actually catches up with it?
Um, I think that there'll always be like a lack of trust between true DeFi and traditional finance because they're two
Yeah.
completely different things,
Yeah.
right?
Hmm.
Traditional finance likes to be and is centralized, right? And
Hmm.
I mean that works for them, and
Hmm.
it's actually a good thing because not everybody wants to interact with the financial products in a non-custodial fashion. Uh,
Hmm.
some people want to effectively be entirely de-risked from their products and have fully managed suites, right? And
Hmm.
so for these people that like the regulation and like the safety nets and so on and so forth, then
Hmm.
centralized institutional-led finance is there. I don't think somebody should put their pension into DeFi, right?
Hmm.
Into any kind of vault, their entire pension.
Hmm.
And so it's two different worlds, and the worlds kind of eat each other's market share and eat each other's lunch. And
Hmm.
so there'll always be that competition there. But I think what we're currently seeing is a rise in institutions using DeFi's utility, right, to be able to make their existing products or new products have more utility, right? So that's what tokenization is. And tokenization now is, leveraging stuff like looping and morpho and stuff like this to be able to effectively open themselves up to a new range of market participants.
So, Matthew, you are somebody who has worked a lot on the Wall Street with the institutions on one side, traditional finance, and now on the other side, you are of course building these amazing protocols whereby people can enjoy these yields, which are far more better than traditional finance. How do you convince or onboard these large institutions? I mean, I wanted to, for the audience, I want to know that what sort of discussions are these? Are they really eager to try it out, or is there still a bridge or gap that you need to still to be kind of, you still need to bridge that gap? So, are institutions really convinced, or do they still need a lot of explanation or a lot of theory behind it?
I think it depends on what type of institutions. If we mean like
Hmm.
institutions like LPs, right, like the large LPs like the flow desks of the world and the
Uh-huh.
yield curators like Edge Capital, so on and so forth. Then I think it's primarily around your risk models. What are you doing to be more transparent, so on and so forth, right? They have, and
Mhm.
like these firms are tending to be quite safe because of all the hacks that have happened as of
Mhm.
recent, and all the loss of funds that have happened. So I think these firms are more worried about those type of things, but are still looking to deploy. Whereas, like what I would say, true institutions are, which is Fidelities, which is BlackRocks and stuff like this. I
Mhm.
don't think they're really touching DeFi in any meaningful way, and I don't think they're doing that for a very, very long while because fundamentally we don't have the regulatory setup for them to be able to touch DeFi. And if we did have the regulatory setup for them to touch DeFi, then either the world has changed a lot or it's centralized finance and it's not DeFi, which is okay. But I think what we will see rather, like I said before, is a rise in utility rather than a rise in direct adoption of our um, votes. So I think the more utility we can create in the market,
Mhm.
the more institutional money we will get. When you become a tool instead of like trying to be a regulated entity, then I think you're in a good place. You can become a regulated entity, but this is less the DeFi route of things, unless some type of DeFi regulation comes out. Yeah.
So, Matthew, you are mentioning a basic difference between what institutions are trying to do with DeFi versus what you are trying to do with DeFi. And you're mentioning utility as the key kind of an ingredient of it, right? So can you just help us understand what does this utility mean? And is it only for retail or is it something that in the future institutions can also onboard to?
So by utility, I mean, okay, so a reason that Fidelity ended up tokenizing their money market fund is because it allows for, atomic settlement that's not T plus
Mhm.
one, which allows for intraday trading, which allows for better reconciliation, which
Mhm.
allows for overnight trading, like all of these different use cases mean that, for example, they can make their money market fund have more
Mhm.
utility by being able to perform better. But then more than that,
Mhm.
um, currently the primary way that you're able to borrow against a money market fund or a NAV-based product is through NAV-based lending. That's OTC, right? That's done institution to institution, B2B. This
Mhm.
kind of limits the amount of individuals that can loop their capital into any institutional product, right? Whereas permissionless DeFi unlocks a new utility where effectively individuals that aren't institutions can loop
Mhm.
into products like this, which increases the leverage on said products like this without having to have the economies of scale that make sense, right?
Mhm.
And so that's extra utility over there, you know.
Mhm.
So it's just, yeah, what fundamental differences are there between the blockchain and traditional finances databases, and then
Mhm.
you find the utility. That core utility is what pervades in traditional finance and is realized in a bunch of different types of use cases.
So we recently heard that you're integrating with Morpho as well, right? So is it part of expanding this utilities layer? I mean, where does Morpho come in all of this?
More for us is yeah, so for us it's expanding the utility of our Vault
Mhm.
token, right? So in the same way, institutions are doing the same, right? Fasanara is doing
Mhm.
the same through Midas. Yeah, Apollo and Anamoy and all of these people are doing the same thing. Our own Vault token, we're effectively just like them in the sense we're a fund, but we exist natively on chain. And
Mhm.
so we're looking for more utility as well. We're looking for more venues to be able to, loop on and collateralize land and so on and so forth.
So what, if I'm not wrong, correct me if I'm wrong, essentially you are running an on-chain fund and that is allowing people to have certain ROI, return on investment, in the form of yields. And I'm sure that when people are kind of making these contributions to get this yield, they will always keep in the back of their mind the hacks and everything that is going on with DeFi. So how much does it really impact the investor sentiment? I mean, the kelp DAO hack we recently saw, of course, the good thing is that DeFi community is coming together. They're trying to help investors as much as possible. But do you really see these hacks actually causing delays in the growth cycle now, or they actually taking us far behind in the growth race?
No, I don't think it's going to take us that far behind. I think fundamentally we've had like quite a few hacks, sadly, in
Mhm.
crypto, and kind of black swan events. We had 1010 the other day. We have this kelp DAO hack. We have, like, I think it's more of a signal for us. Like, yes,
Mm-hmm.
institutions and those LPs and yield creators that are looking for opportunities on chain now will be more careful, but realistically they should have been more careful, right? So like,
Mm-hmm.
it's a thing where like these hacks allow the space to mature, right? Because we need to come together as a DeFi community and prepare
Mm-hmm.
and mitigate them.
Mm-hmm.
um, and so I think, yeah, I think it's just a net positive. I don't think it puts us behind. It can only really move us
Mm-hmm.
forward. If it was going to put us behind, then it would have done that a couple hacks ago.
So, Matthew, I saw that Altura is being able to give yields as high as 20%, right? And in a traditional finance sense, whenever see an yield such high as 20%, we always associated it with risks. So if today somebody is trying to invest with Altura, what should they keep in mind? I mean, are there any hidden risk or something like that, which is allowing us to get to 20%? Or do investors need to really understand that what delta neutral means here?
Yeah, I think the things allowing us to be at 20% are a few different things.
Uh-huh.
So on the quantitative strategy side, the market making, funding rate arbitrage, all of that stuff, like we have amazing quants. And yes, we are delta neutral, which doesn't mean that you can never ever lose money. What it means is that we don't take delta risk, which is we don't take risk on the
Mhm.
price of an asset. We don't make a bet on the price of an asset, or the future price of an asset.
Mhm.
Rather, being delta neutral means that you're buying and selling the asset at the same time and making yield in a different way, right? So funding rate
Mhm.
arbitrage is a great way to do that. You're making money off of the funding rate instead, and you're keeping delta neutral on the price. Yeah, uh, and so because of this, it still means that we have to have risk metrics and risk protocols against, adverse selection, and we have to think about
Mhm.
how fast a single leg can settle. Opening a short and a long on different exchanges and stuff. There's still a lot that goes into it, which is why we have amazing quants. But
Mhm.
when strategies like that are pulled off in the correct market scenarios, then we can achieve pretty good yields. But I think the reason that we're multi-strategy is because of that piece, like in the correct market scenarios, where we've had a good amount of volatility and kind of correct market sentiment for most of the year on our side, the way our strategies work. But we'll always hedge even against that by making sure that we have other strategies, which is why we're multi-strategy vault. And so on the RWA side, we're also making, around that 20% mark through buying up gold from Ghana, selling it in Dubai physically, right, and selling it in Turkey as well
Mhm.
to gold refiners, and making the difference on that, right? And that's effectively taking an opportunity that would have not been accessible to retail because of the economies of scale you have to buy all of that gold, and making it accessible to everybody through a vault structure. It's
Mhm.
trade financing at its core, and it's what I think most. I think it's what I think more crypto projects should do, right?
Mhm.
It's unlocking liquidity for the refineries you're buying from, and then it's
Mhm.
unlocking yield for us, right? It's fair value and it's real. So yeah, so this is why we're able to hit 20%. Um, yeah, hope that makes sense.
So Matthew, if let's say I take gold for example, so for our investors, again, as I said, this is a bit more complicated than a regular investment because it's multi-strategy. It involves things like delta neutral, which people may not have heard before. So if in case I take an example of gold, can you walk us through and help us understand that how does Altura kind of package gold and help us get this return in the end?
Yeah, sure. So the way that our gold trading works is we are partnered up with a commodities
Because I
trading.
must say, sorry to interrupt. I must say this is very interesting. I
Yeah.
mean, the way you are explaining it, and I can understand there is an arbitrage in the play. I do understand that, but I want you to help us understand because this is interesting. I'm telling you, this is quite interesting.
Yeah. So we have a commodities trading desk called Inessa. And
Uh-huh.
what Inessa does, they've been trading commodities and gold for many, many, many years. They have around 400 million on the balance sheet right now. And what they primarily do is buy up. So what they do for us is they buy up Doria Bar gold from somewhere
Mhm.
like Ghana or other mints around the world. And Doria Bar is effectively like unrefined gold. So it's before it's been put into its ingot form, right? So they buy up the
Mhm.
Doria bar, and then they will look for refineries that are acquiring Doria bar gold or want to buy Doria bar gold. who
Mhm.
they have existing relationships with, and then they'll agree on terms, so a price that they will buy the Doria bar gold in order to turn into ingots, and then they'll sell that to that counterparty.
Mhm.
And in doing that, they then have to send the gold through Brinks, who then gives it to Emirates, who then drops it off to the actual gold refinery in the other country, so Turkey, for example. Um,
Mhm.
and we will net the difference in the price for effectively obtaining Doria bar and then selling Doria bar internationally to refineries to be refined. So we're part of a supply chain and commodities processing chain that's
Mhm.
been happening for years and years and years, but has been famously hard for people to kind of jump into because of the capital requirements and because of the logistics requirements. Requires having to, get armored trucks and
Mhm.
kind of liaise with Sky Cargo and stuff like this. So it's and then the adverse selection that you get with choosing mines means that you could choose a mine that could give you really
Mhm.
terrible quality Doria bar, right? And that means that effectively you won't be able to realize any profit, right? So it's about having those relationships that you know before, that trust layer, and having an amazing team that's able to audit and understand the people that you're selling to and buying from. So yeah,
So this all is happening on chain.
exactly, yeah. So the trade is getting settled on chain, and the logistics movements are all being signed signature wise on chain with a partner that we have called Aurelian, who is in charge of our tokenization effectively and in charge of basically making every single point of this supply chain
Mhm.
transaction that's viewable. Yeah. So every single time the gold changes hands, changes custody, there's a signature and a wallet tied to who currently custodies the gold physically. Which is different to, like, I don't know,
Mhm.
Tether's XAUT gold tokenization, because just because you have XAUT in your wallet doesn't mean you have XAUT in your house.
Mhm.
Whereas with us it does. And so we worked really hard with our tokenization provider to come up with a solution that works for what our LPs and what institutions wanted. Yeah,
So this is more like self custody of gold rather than putting it in some reserve somewhere, which is
exactly.
brilliant. It's brilliant. Yeah, yeah.
Yeah, it is,
So
it is really, really cool.
I mean, if so, what's the minimum value somebody can invest in Altura and get started?
As much as they want, right? One, I don't know, cent. I don't know how small USDC goes, right?
Okay.
But yeah, you just deposit into vaults, and then your money is put to work.
And given the current scenario, I mean, the geopolitical situation globally, I'm sure the volumes must be spiking.
Yeah, yeah. So I mean, yeah, the amount coming in, we had a lot of withdrawals post Kelp,
Uh-huh.
um, but in some ways, it makes it better for us when stuff like this does happen, because
Hmm.
we haven't had exposure to Kelp. We haven't had
Hmm.
exposure to any of the major, hacks that have happened as of recent. And
Hmm.
so, our community has faith in that because of the fact that, hey, look, our money's safe. These guys have, their heads screwed on. And further
Hmm.
than that, we do have, insurance against
Hmm.
protocol mistakes and hacks and employee theft and a bunch of different scenarios. Right now, that insurance is 5 million. It's going to go up to 10 million very soon, and then up to 15 and 20 and so on and so forth. So even if that did happen to us, users would be reimbursed via insurance,
Hmm.
our insurance, which is with native insurance.
So, uh, practical question comes to mind, Matthew, is that where does this place uh, Altura in the whole scenario right now of institutional adoption? Do you see institutions tomorrow using Altura as a layer, or do you see them as competitors at the moment?
Don't see them as competitors, and I don't know. Maybe they'll be adopters in the sense that some institutions have
Hmm.
funds to LP.
Hmm.
Again, I think it depends on what type of institutions you're targeting and want to talk about. I think
Hmm.
if the Fidelities and the BlackRocks and the JP Morgans, not anytime soon. That's not our current
Hmm.
target. Maybe in
Hmm.
a few years. Um, if you're talking about the edge capitals, yield curators, these type of people, then we're already flow desks. We're already talking to them actively every
Hmm.
day. Yeah.
Okay, okay. So, Matthew, Where does Altura go from here? I mean, what are your, let's say, roadmap goals for the next 2 years, 3 years, 5 years?
Yeah, so I think for us it's more diverse. It's just being better at what we're doing right now. So
Mhm,
more yield diversification, bringing more utility that doesn't exist on chain currently,
mhm,
and wrapping it in a vault with our tokenization provider. I think that would be really really cool if we can do more than just the gold trade. If we can do silver and gems and all sorts, then that would be very very cool. Because effectively diversified yield means diversified risk for our customers. And just
mhm,
it's just interesting on a practical level. The more places we can provide liquidity to, the more markets we can make work and trade finance, the more people's lives we affect and make well. So I think just yeah, getting better at that front, and then as well as that, I think at some point we may shift into hopefully being more like a neobank in a sense. Maybe having our
mhm,
own
mhm,
cards or having our own, just kind of like what Revolut and a lot of these platforms are doing, when they're trying to give savings to their customers. I believe that DeFi is uniquely positioned for that because of the fact that like the yields that you can get on a DeFi savings account is a lot is much much higher than the yields you can get on, I don't know, let's say your Revolut account, right? Um,
mhm,
I think the big blocker for crypto for a long time has just been the payments part, right? Like it's
mhm.
great you can earn, it's great that you can accrue, but like why can't I spend? And so I would like to start thinking about uh, you know coming at this question, because it shouldn't only be institutions that can unlock more than 1% of APY
Mhm.
on an account that they can also spend and move money from, right? Yeah.
I mean, this is, of course, this is quite interesting because we all have known that DeFi can provide yields which are far more better than traditional finance. The only question that has remained so far is that is it actually decentralized? Number one, but the way you are explaining me, it seems quite decentralized to be frank, because now the assets are not just sitting in some physical vault somewhere or reserve. They are actually being part of the supply chain. They are actually being transported with the supply chain at each step, and it's amazing. I mean, personally, I will definitely check the platform for the podcast, and I will definitely like to see the experience that. So, I mean, the way stable coins made payments easier. I mean, today a company like us almost sends our 90% of the salaries globally using stable coins. It has
Mm,
been revolutionary. And this seems to be quite the similar way you are trying to position DeFi. That just like stable coins, it is something that is not dependent on borders and it can be settled within few seconds.
exactly,
So,
exactly, exactly. And I think the key to that is making it so people don't have such an arduous time like on ramping, spending, off ramping,
mm,
so on and so forth. If I've made, if I want to put all of my money into a vault, I don't want to have to, spend like 3 hours unwinding that all so I can buy something,
mhm,
so I can buy a burger, right? Like I want to be able to use it actively. Otherwise, the utility for it kind of starts to it goes down, right?
mhm,
And so I think ease of use has been a massive blocker to the crypto space and to people adopting cryptocurrency and DeFi. And so I think
mhm,
just making it easier for normal everyday individuals to use DeFi is a massive, massive win. I think people shouldn't realize that they're even using DeFi, right?
mhm.
So yeah.
So, Matthew, one last question and then we will wrap this up. I know you're a busy person, but we can have one last question, right?
Yeah, yeah, of course, of course.
So, Matthew, when it comes to DeFi today, we do see a lot of regulations being prompted and debated on online. For example, Clarity Act, there was Genius Act as well. How much do you think these things will actually impact the existing roadmap that Altura has? Because when investors actually see these updates, they tend to be a bit cautious. They want to first see what is happening. They want certain certainty around it. So, do you really think these upcoming regulations, particularly like Clarity Act, playing an important role in kind of growing the whole scope of work for Altura?
I think it's yet to be seen, right? I think Altura isn't a regulated entity in the normal sense, right? And most DeFi platforms aren't.
Hmm.
Um, we are like decentralized in the sense that like we operate from many different jurisdictions as a company. We're deployed across many different chains. Um, And I don't know, there's certain jurisdictions where crypto sucks to trade in, the US being one of them. Um,
Hmm.
but I think we've always found a way to survive and thrive. So a lot of the time as well, regulation can help us, right? Like in terms of transparency, the
Hmm.
block like every trade is reported on the blockchain. You can see exactly how yields work on the blockchain, right? So in
Hmm.
some ways, or in all ways, regulation is good. It either makes us more decentralized or it makes us safer, right? It does one of the two things. So I'm not too worried about it right now. Um, yeah, I'm just interested to see how it pans out and affects the rest of the market and it affects institutions and so on and so forth.
So, Matthew, thanks a lot. I mean, the user experience, particularly that you're explaining that Altura has, I think it is top notch. I will personally give it a try, and I will request my audience as well to give it a try, because when I first tried stable coins, I was mind blown. I mean, I couldn't see the reason why this is not being adopted.
Mm.
And finally, the regulations are also catching up there. The same is with DeFi as well. I mean, if somebody has used any DeFi protocol, they have collateralized any cryptocurrency and they have borrowed stable coins or something like that, I'm sure they enjoyed that experience. They are never coming back. So I
Yeah,
hope
yeah,
that's
it's
same
true.
for I hope that is same for Altura as well. My best wishes, and thanks a lot again for giving us your time today.
Thank you. I appreciate it.